Hello and welcome back to our webcast series on connectivity between IFRS accounting and IFRS sustainability. We have a joint team of IASB and ISSB presenters for this series. My name is Gabriel Benedict, and I'm a part of the ISSB technical staff.
And my name is Gustavo Olinda, and I'm part of the IASB technical staff.
This is episode 2 of our webcast series. As explained in our first episode, in episodes 2 to 4, we will walk you through a series of examples where we will look at the reporting outcomes of applying both sets of our standards together. We have prepared these examples to illustrate how applying the IFRS standards together as a package results in connected and complementary reported information. Our examples for this series are focused on climate. As shown on this slide, the examples will cover 3 topics: climate-related risks and impairment of non-financial assets, climate-related opportunities and changes in product mix, and climate-related commitments. In this episode, we will cover our first example, which is about climate-related risks and impairment of non-financial assets. Before watching this episode, we invite you to watch episode 1, in which we provide a theory refresher and explain how our standards are designed to work together. Now, we have a few housekeeping points that apply to all of our examples as we explain on this slide. We would like to emphasize that these examples are basic illustrations of how IFRS standards work to support complementary and connected information. The examples do not illustrate all requirements in IFRS standards, nor do they provide a complete set of illustrative disclosures. From the ISSB standards perspective, we will focus on 2 areas. Firstly, we will illustrate how disclosures about the current and anticipated financial effects of sustainability-related risks and opportunities expands on and complements the information in financial statements. Secondly, we will focus on other disclosure requirements in the ISSB standards that are of particular interest in the fact patterns discussed in illustrating complementary and connected information with related financial statements. The examples follow a consistent structure. We will first discuss the information reported in the financial statements, followed by information reported in sustainability-related financial disclosures. When we talk about information in the financial statements related to the climate-related risks and opportunities described in the fact patterns, we will consider, first, whether there is an effect on the recognition and measurement of assets, liabilities, equity, income, and expenses. So, is there an actual effect on the amounts reported in the financial statements? Second, if recognition and measurement are affected, whether disaggregated information about those effects is provided in the financial statements. So, is the effect visible in the financial statements? And finally, the examples will consider other related disclosures that are provided in the financial statements. And as mentioned before, in discussing information reported in the sustainability-related financial disclosures, we will focus on current and anticipated financial effects related to the climate-related risks or opportunity, and other disclosure requirements that are of particular interest in the fact patterns discussed in illustrating complementary and connected information with the related financial statements.
Our first set of examples is about climate-related risks and impairments of non-financial assets. We have developed 3 fact patterns that illustrate different ways in which these risks can affect the recoverability of non-financial assets and result in or contribute to impairment losses. Let's start with the first example. In this example, we have an entity whose operations result in a high amount of Scope 1 greenhouse gas emissions. The entity is subject to regulations in one of the jurisdictions in which it operates, jurisdiction A, which require it to acquire allowances for some of its GHG emissions. The entity's operations in jurisdiction A are part of a cash-generating unit to which goodwill is allocated. The entity tested that CGU for impairment and concluded that the carrying amount of the CGU was recoverable, so it recognizes no impairment loss. As part of that impairment test, the entity has made assumptions about the future price of GHG emission allowances. These are key assumptions as described in IAS 36. That is, they are among the assumptions to which the CGU's recoverable amount is most sensitive. The entity also conducts climate-related scenario analysis to inform its disclosures about its resilience to climate-related risks for its operations in jurisdiction A. Now let's discuss the information that the entity would report in its financial statements. As I mentioned before, the entity concluded that the CGU is not impaired. Therefore, there is no effect on the recognition and measurement of the assets in that CGU. Accordingly, there are also no financial effects in the reporting period about which to provide disaggregated information. Nonetheless, in this example, the entity would disclose information about climate-related assumptions in its financial statements. Because the carrying amount of goodwill allocated to CGU A is significant in comparison with the entity's total carrying amount of goodwill, some specific disclosure requirements in IAS 36 will apply. In particular, IAS 36 requires the entity to disclose information about the key assumptions used in the impairment test. In this example, the entity would disclose that its assumptions about the future price of emission allowances are key assumptions. The entity would also disclose the approach it took to determine the values assigned to those assumptions. For example, the entity discloses whether its assumption about the future price of emission allowances is consistent with external sources of information, and if not, how and why it differs from those other sources of information. And finally, IAS 36 requires an entity to disclose further information if a reasonably possible change to a key assumption would result in an impairment loss. If that is the case, Entity A would disclose the headroom, that is, the amount by which the CGU's recoverable amount exceeds its carrying amount, the values assigned to the key assumptions, so for example, the emission allowance prices used in the impairment test, and finally, the amount by which the values assigned to the key assumptions must change for the CGU's recoverable amount to equal its carrying amount. As you can see, the disclosures in financial statements are focused on the recoverability of the underlying assets, and the extent of the information an entity discloses depends on the risk of an impairment loss. So for example, the smaller the headroom identified in the impairment test, the more likely it is that an entity would have to disclose further information about the assumptions it used.
Now, when the entity prepares its sustainability-related financial disclosures, it identifies a climate-related transition risk from its operations emitting a high amount of Scope 1 GHG emissions, which includes the GHG emissions regulations that it is subject to. The entity would provide information about this climate-related risk. The information provided might include explaining how the climate-related risk has affected the entity's financial position, financial performance, and cash flows for the reporting period, that is, the current financial effects of that risk. In this example, the entity would explain that this risk has not had any financial effects in the reporting period. How the climate-related risk is anticipated to affect its financial position, financial performance, and cash flows over the short, medium, and long term. That is, the anticipated financial effects of that risk. This might include the expected cost to purchase GHG emissions allowances in the future. When providing information about anticipated financial effects, the entity considers how its assessment of the resilience of its strategy and business model, which includes the use of climate-related scenario analyses, might inform the disclosure it prepares about the anticipated financial effects of this risk. In terms of our other areas of focus for this fact pattern, we have highlighted requirements related to disclosure of an entity's climate resilience as a particular area of complementary and connected information. Climate resilience disclosures provide information about the resilience of the entity's strategy and business model to climate-related changes, developments, and uncertainties, taking into consideration the entity's identified climate risks and opportunities. So relevant to this example, the entity considers how it will be impacted by regulatory policy. As part of these disclosures, the entity would provide information about its climate scenario analyses, including key inputs and assumptions. This might include information about the future price of GHG emissions allowances, as well as the climate-related policies in the jurisdictions in which the entity operates. Regarding tools to support connectivity, IFRS S1 requires that an entity use data and assumptions that are consistent to the extent possible, considering the applicable accounting requirements, with those used in preparing the financial statements.
Before we move on to our next example, let's take a step back and think about what this example is telling us. We are looking at the same reporting entity and the same phenomena. We have a fact pattern in which the entity's operation results in high GHG emissions, and there's an obligation to acquire emission allowances. So there is already a connection right here. But although we are looking at the same entity and the same phenomena, we are doing so from a different perspective. In financial statements, we are focused on the recoverability of assets, and the disclosures are related to that particular aspect. Whereas in sustainability-related financial disclosures, we are focused on the resilience of the entity's business model and strategy, which provides a complementary perspective. And when providing this information, the entity is required to use data and assumptions that are consistent to the extent possible with data and assumptions used in financial statements. This is another example of connected information. And now let's move on to our second example, which is about impairment of non-financial assets, but this time we do have an impairment loss. Let's look into how this fact pattern translates into the information the entity would report. In this example, an entity has manufacturing facilities in an area subject to climate-related risks, such as an increasing frequency and severity of floods. During the period, a flood event severely damaged the entity's facilities in that area. As a consequence, the entity concluded that the PP&E in these facilities, including buildings and machinery, are fully impaired and need to be replaced. First, let's discuss the information the entity would report in its financial statements. As I just noted, in this example, the entity recognizes an impairment loss on the PP&E damaged by the flood. These items are fully impaired, so their carrying amounts are reduced to nil in the financial statements. The impairment loss is not disaggregated further because it's fully attributable to the flood event. IAS 36 also requires an entity to disclose information about assets for which an impairment loss was recognized during the period. In this example, the entity would disclose the events and circumstances that led to the impairment loss, that is, that the flood event severely damaged some of the entity's facilities, the amount of the impairment loss, the nature of the assets damaged by the impairment event, that is, buildings and machinery, and finally, the entity would disclose that the assets were fully impaired. These disclosures are focused on information about the affected assets and the impairment loss recognized in the period. We will now see how the sustainability disclosures would provide further context about the climate-related risks that are related to the flood event.
In this example, the entity identifies a climate-related physical risk due to its manufacturing facilities being in an area subject to increased frequency and severity of floods. The entity would disclose the amount of impairment loss recognized in the financial statements as a current financial effect of this climate-related risk because the resulting impairment is fully attributable to the flood. Since the entity provided this information in the financial statements, as Gustavo just mentioned, to avoid duplication, the entity might provide this information in sustainability-related financial disclosures by cross-reference to the financial statements subject to specific conditions. In addition to information about the current financial effects, the entity would provide information about how this climate-related physical risk might affect its financial position, financial performance, and cash flows over time. In this fact pattern, this might include information about costs the entity expects to incur to replace its damaged assets, as well as insurance-related costs resulting from the flood. Consistent with example 1A, we highlighted the entity's climate resilience disclosures as a related and particularly complementary disclosure. These disclosures would include information about how its business model and strategy might be affected, including availability of and flexibility in the entity's financial resources to respond to this risk, and the effect of any planned mitigation or adaptation activities. Information about inputs and assumptions would also be provided, including which scenarios the entity used for the analysis. Now let's take a step back and think about how this example demonstrates connected and complementary information. This example shows this area of potential overlap where there are requirements for an entity to disclose information about the impairment loss both in the financial statements and sustainability-related financial disclosures. The example highlights that we have tools in our toolkit that not only facilitate the provision of that information in a connected manner, but also avoid duplication. So now let's move on to the last example related to impairment of non-financial assets. In this example, we have an entity exposed to climate-related transition risks. The sales of one of the entity's main products, product C, have been declining due to adverse economic and market conditions, and the entity expects that trend to continue in the future. One of the factors resulting in these adverse market conditions is the effects of shifting consumer demand for product C related to climate considerations. So here you could have an example where climate-conscious consumers have been moving away from that product because of its effects on the environment. The entity in this fact pattern recognizes an impairment loss for the related CGU in the reporting period. However, the shifting consumer demands I mentioned before are just one of the factors contributing to that impairment loss and do not fully explain that loss. So thinking about our three examples together, in example 1A, we have a fact pattern where climate-related risks are reflected in an impairment assessment, but the entity incurs no impairment loss. In example 1B, we have an impairment loss that is entirely attributable to that climate-related risk. And now, in example 1C, we have an impairment loss, but the climate-related risk is only one contributing factor. Let's now look at what information the entity would report in this last example.
As in the previous example, the entity recognized an impairment loss in the period. However, in this example, climate-related matters are one of many factors that might have led to the recognition of that impairment loss. IAS 36 does not require an entity to provide disaggregated quantitative information about the effects of various factors on a recognized impairment loss. Accordingly, the entity would not provide such disaggregated information. IAS 36 has specific disclosure requirements that apply when an entity recognizes an impairment loss. So similarly to the previous example, the entity would disclose that adverse market and economic conditions led to the impairment loss. The information an entity would disclose would also include the impairment loss amount and further information about the measurement of the CGU's recoverable amount. That information may vary depending on whether the recoverable amount is based on fair value or value in use. Like the previous example, the disclosures are focused on the reduction in the value of the assets in the CGU. Gabe will now explain how the different objectives of sustainability disclosures provide a complementary perspective by focusing on the related climate-related risks.
As noted in the fact pattern, the entity identifies a climate-related transition risk. Unlike example 1B, where the financial effect, being the impairment loss, was fully attributable to a climate-related risk, in this example, the climate-related risk was only one contributing factor to the impairment loss. The entity is required to disclose the loss attributable to the climate-related risk. If the entity is unable to quantify the loss attributable to that risk, either because the effect is not separately identifiable or because the measurement uncertainty is too high, The ISSB standards accommodate this situation by providing relief from disclosing quantitative information. In those cases, the entity would be required to provide qualitative information about the effect, such as identifying line items, totals, and subtotals in the financial statements that have been affected, as well as provide quantitative information about the combined financial effects of the climate-related risks and other factors, which could be the total impairment loss. Information about anticipated financial effects might include disclosure of expectations about the continued decline of product C's sales. Consistent with the reliefs provided for current financial effects, if the entity is unable to quantify anticipated financial effects of climate-related risks, it would be required to provide qualitative information by identifying, for example, the line items expected to be affected and the combined financial effects. The ISSB standards also require disclosure of information about the entity's strategic response, that is, how the entity has responded and plans to respond to the climate-related risks in its strategy and decision-making. This might include information about key assumptions, such as developments or changes to product C.
Before we end this episode, let's quickly recap all the examples we covered today. We have looked at how we have the same entity and the same facts and circumstances, but we look through different lenses and provide different information. Financial statements focus on the underlying assets and their recoverability, and the related disclosures in financial statements support this. Sustainability-related financial disclosures, on the other hand, provide complementary, contextual information focusing on the resilience of the entity's business model and its strategy, and how the entity is managing the related climate-related risks. We also looked at how, even in the areas of potential overlap, such as current financial effects of the climate-related risks, the information can still be complementary, and sustainability disclosures provide additional granularity in information. And finally, we also looked at how the information is connected, for example, using the same data and assumptions to the extent possible, and how the requirements in the ISSB standards allow an entity to provide information by cross-reference to avoid unnecessary duplication. That brings us to the end of the second episode of our webcast series on connectivity. We hope this webcast was useful in illustrating how IFRS standards provide connected and complementary information when it comes to information about the effects of climate-related risks on the recoverability of non-financial assets. We are looking forward to having you join us for our next episode, where we will walk you through an example about climate-related opportunities. Please note that you can find all of our episodes of the series on our website, and we invite you to take the time to review them. Thank you for joining us.